Hello and welcome to Live Wire Markets. My name is Chris Conway. Today I am joined by Phil Strano from Yarra Capital Management. Phil is the lead manager for the Yarra Higher Income Fund, which recently marked its 5-year anniversary. Phil, firstly, congratulations and welcome to Live Wire Markets.
Look, thanks for the opportunity to be here. It's always great to talk to you.
Can you please briefly explain the fund that you look after? What part of the fixed income market do you invest in?
The fund I look after is the Yarra Higher Income Fund, and it's basically a multi-sector credit fund looking at Australian credit and literally what I call kind of picking the eyes out of the market and focusing on higher risk-adjusted returns, getting a blend of assets that can kind of optimise the risk-return liquidity paradigm and effectively focus on alpha as much as we can to what we think is to kind of deliver a superior performance for investors.
Phil, the fund recently celebrated its 5-year anniversary. The past 22 months have been very volatile. Can you just talk to us a little bit about the journey over the 5 years and then more specifically the last 22 months where it has been quite a crazy journey?
It's been an interesting 5 years. I mean, kind of came in and the fund was pretty subscale going into the pandemic, which meant that we kind of had a kind of significant drawdown, which, mostly was related to its kind of lack of diversity. But then coming out of COVID, we attracted more money, we got to scale. We also had an institutional part of the business which grew, which gave this fund additional capacity. And what you see now is a far more diversified fund, true to label and delivering from a performance perspective. If I think about the last 22 months, it's a really good environment now. 21, obviously we kind of hit a point, kind of a low point in terms of yields. And it's a really interesting thinking about it because when we talk to investors nowadays, we're kind of talking about yields because they're so attractive as opposed to kind of the focus on spreads prior to or around 2021 when things got just so expensive from a yield perspective. So it's a much, certainly a lot more fun managing portfolios in this environment. Yields are attractive, but it's also a case that it's also providing a lot more defence. So when you're kind of talking about investment grade portfolios of 7-8%, the chances of you delivering a negative return, it's infinitesimally small. And I think investors are starting to understand that, and that's the real attraction of investment grade rated portfolios.
Phil, is the fixed income market in better or worse shape now? So I know you've talked about the opportunity and you don't have to reach for yield anymore, but the overall makeup of it, is it in a better place for investors and is that likely to continue moving forward?
I think it's in a much better place for investors. When you think about, like I said, the yields, the fact that base rates have kind of picked up by about 400 basis points and normalised, you probably have to go back to pre-GFC to see an environment like this. And it gives investors a lot more opportunity to earn those kind of returns that we're talking about without just taking much risk. If I think about in terms of an environment, what this feels like I said, something like pre-GFC, but going back further than that, given all the risks in the market at the moment, geopolitics and all the rest of it, and not that I was around back then, but it kind of feels like the 50s and 60s if you kind of look back.
Phil, before we talk about fixed income more specifically, can I get your take on the Australian economy and interest rates, obviously the big moving part?
Certainly our senior economist, Tim Toohey, believes that there potentially another rate rise on Cup Day. He's going 15 basis points to get back to that quarter increment. And we kind of, looks like 2024, those kind of rate cuts that everyone was kind of factoring are going to be pushed out towards the latter part of the year. So, this kind of thematic about higher for longer, I do believe that. I think governments are spending up big. Economies are proving to be a lot more robust because of that government spending for all sorts of reasons. And that's just going to mean that interest rates are going to be a fair bit higher than what we've been used to.
Phil, how has the volatility that we've had over the past couple of years shaped the current market? And what I mean by that is, has there been a flood of new issues? How are things being priced along those sorts of lines?
Well, I think people have kind of understood duration, and certainly from a traditional fixed income perspective, fixed income has adjusted. It's got no choice, has to adjust. There's certain parts of the market that have adjusted, certainly listed assets around duration, commercial property, There's been an adjustment there that's gone through. There's certainly an unlisted side of the market where you still likely have to see that kind of adjustment come through. But overall, I go back to thinking about kind of investment grade right now. And from an investment grade credit perspective, it's its time in the sun.
Phil, there's a lot of talk about a massive wall of government debt that's going to flood the market. Mm-hmm. If that happens, what impact would it have on corporate funding rates?
Yeah, so it's going to keep yields elevated. But you think about it from an investment grade perspective. So an investment grade credit doesn't have an impairment risk profile. So it doesn't get impaired. So if you're a accredited investor and you're looking at elevated yields and you think about investment grade and you know it doesn't get impaired, you're quite happy to kind of not worry too much about the spread over government bond. So what we're seeing is that credit spreads are actually performing really strongly at the moment. And that's basically because of the attractiveness of the outright yields and the comfort that people have with those investment grade corporates and issuers. And I think that's a thematic that's likely to continue. That is leading to the primary being really well supported, issues trading really well in secondary, and us reaping the benefits from a performance perspective.
Phil, you've sort of touched on it already, but over the course of your career, is this the best opportunity set you've seen when it comes to the space that you invest in?
Absolutely. I mean, you kind of think about, even though I said pre-GFC, Bank Senior, I was a lot younger back then. I probably had a little bit less grey hair. But pre-GFC, Bank Senior used to trade at 5 over swap. Mm-hmm. It's currently still roughly, anywhere between 90 to 100 over swap. And that's with yields being akin to where they were back then. So you can see scope where credit spreads could actually continue to perform particularly well if the economic conditions remain as robust as we're currently seeing. So it is a really different thematic, and for me, it really feels like we're in a different era. So we've kind of gone out with that era of inflation not being below band, interest rates continuing to decline, people not necessarily being happy not to take wage rises because the house price kept going up. I think now we're in a different thematic, and it's something a little bit different. Inflation is likely to be stickier, interest rates are likely to be generally higher than what they would otherwise be, and people are going to want more wage rises, which is basically going to just reinforce that cycle. Now, if I think about credit, I think about investment grade again, no impairment risk, debt capital is going to be higher, higher cost for them. They can stomach because they have pricing power and they can pass on to consumers. From an investment perspective, it's a great place to be.
Phil, let's talk about where the rubber meets the road, mm-hmm. and the portfolio and how you're constructing it across the factors, quality, duration. What does it look like right now? What is the portfolio made up of?
So it's made up of, like I said, our best ideas across a really wide opportunity set. When you look at a multi-sector Australian credit, it is a huge opportunity set. It's something akin to the same size as the ASX. So for us, it's really about being nimble and focusing on where we're getting paid for risk, because that is the ultimate mantra that we have. And right now, bank hybrid capital, tier 2, mm-hmm. still works. It's still priced really attractively, and that will continue to provide performance. I also think RMBS is still a fantastic sector to be in, because what we're seeing at the moment is that households are prioritising their mortgage payments over other aspects of the economy. They're cutting back on spending in terms of discretionary spending to prioritise their mortgage payments. House prices have basically recovered to where they were. Surprise to me, and a surprise to many people. And it means that basically all those attractive RMBS spreads that we've seen, 7, 8, 9% for investment grade tranches in RMBS are really looking good to perform, not just from an income perspective, but also capital as spreads normalise when the market gets really comfortable that we're not going to have a house price crash.
Phil, how long do you think this period of not having to reach for yield is going to last?
I think like I said before, I think we're in a different era, and I think we're going to be here for an elongated period of time. If you think about everything that's going on in the world at the moment, and there's quite a bit, a lot of it is not particularly nice. Yep. But the geopolitics, the winding back of globalisation to a degree, the fact that US wants to decouple from China as much as it can, these are all higher cost options So the market's sort of focusing now, or governments are focusing now on sustainability, sovereign capability. All these things come at a higher cost than they would otherwise be, and they're basically decisions being made not purely on economics of cost. So that to me means that inflation, like I said, is likely to be higher. Interest rates will be higher, and it will just mean that the cost of debt capital is just going to naturally be higher for an elongated period of time. And as a credit manager, provided we can kind of manage any kind of impairment risk, and which I think we can if we kind of stick to more of the investment grade quality sector, we're going to offer investors some really good risk adjusted returns.
Phil, just a quick follow-up question there, just on in terms of managing the risk. What are the practicalities of that? Like, how do you determine if something comes across your desk? How do you decide, no, that's too risky, we won't take that on board? What are some of the elements that you look at?
Yeah, so I mean, we have a proven investment process. So we manage we basically risk rate everything that we look at. So every investment has its own credit rating that we apply, regardless of whether it's basically rated by an external rating agency or not. And then once we apply the risk, then we go through the relative value measures and have a look at documentation and making sure that what we're buying is actually what we're buying, and then looking at the return and making sure we size it properly for the risk that we're taking in the portfolio. So we kind of generate this really diverse mix of assets that all individually kind of add to the carry, and make sure that we kind of dull that volatility as much as possible. Because we want to give investors a really good experience of attractive returns, but also quite dependable income.
Phil, the $1 million question, what sort of return should investors expect over the next 12 to 24 months, let's call it?
If I look at the running yield forecast from the fund at the moment, it's in excess of 7%. If you factor in capital on that, I would look at the last 12 months, we've done over 9%. I think something in the order of 7 to 8 is quite achievable on investment grade credit quality.
Phil, Yarra is well known for having a broad view of the fixed income landscape. You've been in the seat now for 5 years. Again, congratulations on that anniversary. What's the one thing that you've learnt over that period? What's your view from the top, if you will?
It's all about being resilient. So the heights of the lows of COVID, and the ability to kind of basically just take stock and reassess and keep working at finding mispriced assets and delivering for clients. So the work never really stops. You look at it every single day, and it's really just about just looking at the market that's in front of you and positioning the portfolio accordingly to kind of generate that returns over the near and medium term.
Right.
Because I mean, a lot of these asset classes don't turn on a dime, but they eventually come good.
Yeah, great. Thanks, Phil.
Thanks, Chris. Appreciate it.